Is this going to be more of Snap or more of Alphabet?
Well, that's the question, because Meta shares are up nearly 4% this morning in the wake of Google's Alphabet's better than expected results. But those shares are still down nearly 10% for the week ahead of earnings this afternoon. Now, these earnings are expected to be when Meta reports its first ever decline in revenue after last quarter. Its Facebook app reported its first ever decline in users. This all comes as investors brace for Meta to suffer from all the same issues that have hurt the other ad platforms. Macroeconomic pressures causing a broad ad pullback, challenges navigating Apple's operating system changes, and growing competition from TikTok. Now, Alphabet reported yesterday, and while the overall picture was good, YouTube's ad revenue decelerated to 5% growth. That is short of estimates, while last week both Snap and Twitter fell short of both top and bottom line expectations. Now, for Meta, whose stock is down about 50% year to date, analysts are expecting a 0.4% decline in revenue to just under $30 billion, while earnings per share are projected to decline 28%. But 70% of analysts have a buy or overweight rating on the stock. Bank of America with a buy rating saying that the ad recession may have already started, and they expect a better 2023, projecting that the company will have an optimistic outlook on monetizing Reels, improving ad targeting, and also slowing metaverse spend. But there have been some recent signs that Meta is grappling with some growing challenges. Mark Zuckerberg told employees at the end of June that this is, quote, one of the worst downturns we've seen in recent history. And Instagram, we've been talking about the fact that it just rolled out some changes to compete more directly with TikTok. We see if all of that creates kind of a perfect storm or whether Meta's scale helps insulate it, more similar to what we saw from Alphabet. John?
Julia, are analysts saying that the stock is more likely to move on revenue or on profit? Because Facebook, Meta, has a bit of a history of sandbagging on the cost expectations, and then when times get tough, spending way less than expected and goosing that bottom line number.
Well, what's so interesting here is that if Meta shows declining revenue growth for the first time, that would be just a dramatic shift. This is a company that has had such consistent revenue growth. I think that would sort of represent a sea change in terms of where Meta fits into this ad landscape. But there is something really important right now about the bottom line. Investors are looking for Meta to cut back on spending, and particularly cut back on spending on some of these long-term, more moonshot type bets on things like the metaverse. So I think this is a situation where we can see both come into play. The most important thing, I think, is going to be the top line results and this question of how much the overall pie is shrinking, the overall revenue is shrinking. But if we hear more and more about being fiscally cautious in terms of how they're allocating spending, I think that will reassure investors. But that's the kind of thing that tends to come out during the earnings call. So I think the first move will be on the revenue.